Most people think a chargeback is just a refund. It is not. It is a card dispute that can pull a payment back. In a normal sale, the payment moves toward the merchant. In a chargeback, that flow can reverse after the customer has already paid. That is why a chargeback feels so different from customer service. It brings banks, card network rules, deadlines, and evidence into the payment. For customers, chargebacks can protect against real problems. For merchants, they can mean lost revenue, fees, paperwork, and account risk. To understand chargebacks, keep a simple map in mind. Cardholder, merchant, issuing bank, acquiring side, and the card network between them. Start with a normal refund. The customer contacts the merchant agrees, and the merchant sends money back through the normal refund process. In that path, the merchant is usually the one deciding to correct the sale, return the funds, replace the product, or cancel the order. A chargeback starts differently. The cardholder asks the issuing bank to dispute the payment instead of only asking the merchant for help. At that point, the complaint is no longer just a conversation between customer and merchant. It is moving through the card payment system. A refund is a merchant action. A chargeback is a dispute process. They can both return money, but they do not work the same way. Before the dispute exists, there is an ordinary card purchase. The customer pays, the merchant accepts the card, and transaction records are created. In many cases, the issuing bank already authorized the transaction earlier. That approval did not prevent a later dispute from being filed. The transaction may also have moved through clearing and settlement. So the chargeback is often trying to undo something that already moved forward. That timing is important. The customer may dispute the transaction days or weeks later, after a receipt, shipment, or account record already exists. The customer is not simply wiring money backward to the store. The adjustment moves through card system relationships and accounting entries. The cardholder is the person who sees the transaction and asks the issuing bank to dispute it. The merchant is the store, website, service, or platform account that accepted the payment and may now need to respond. The issuer is the bank or financial institution that issued the card. It receives the cardholder's dispute request first. The acquirer or acquiring side provides card acceptance services to the merchant and passes dispute messages to the merchant side. The card network provides the rules, message formats, deadlines, and paths that let the dispute move between the two sides. A processor, payment facilitator, or commerce platform may sit in the middle and deliver notices, evidence tools, and account debits. So the dispute is not just one complaint. It crosses customer terms, merchant policies, processor rules, bank procedures, and network rules. One common reason is fraud. The cardholder may say they did not authorize the transaction or do not recognize the merchant descriptor. Another reason is non-receipt. The customer says they paid, but the product, service, or digital access never arrived. A chargeback can also happen when a customer believes the same transaction was charged twice or charged for the wrong amount. Sometimes the customer expected a refund or cancellation credit, but it did not appear quickly enough or was not processed correctly. In other cases, the customer says the goods or services were defective, misdescribed, incomplete, or not delivered as promised. There is also friendly fraud, where the cardholder disputes a charge they actually made, forgot, misunderstood, or decided to challenge later. Inside the system, the dispute usually becomes a reason code. That code shapes the evidence needed and the deadlines that apply. Exact chargeback categories vary by network, country, card product, merchant type, transaction type, and the specific facts of the sale. The process usually starts when the cardholder contacts the issuer and says there is a problem with a transaction. Depending on the rules and the case, the issuer may give the cardholder a temporary credit while the dispute is investigated. The issuer does not simply believe every claim forever. It may screen the dispute, classify it, and decide whether to send it forward. If the dispute moves forward, it travels through the card system to the acquiring side. The merchant may receive a notice and a deadline. Often, the disputed amount is debited from the merchant side before the merchant has finished responding. The merchant now has a limited window to respond. Missing the deadline can mean losing the dispute even with useful evidence. At a high level, the merchant has two choices: accept the chargeback or challenge it with evidence. If the merchant accepts it, the disputed amount stays reversed and the case may end there. If the merchant challenges it, the response has to match the claim. A pile of random documents is weaker than focused evidence. Evidence is the center of the process. The merchant is trying to show that the transaction was valid or that the claim is incomplete. For some claims, authorization records can matter. Approval data, card verification results, device signals, or authentication details. For not received claims, tracking numbers, delivery confirmation, usage logs, service records, or signed pickup evidence can matter. Customer emails, chat logs, support tickets, refund promises, and cancellation conversations can all help explain what actually happened. For digital products, account creation, login history, IP signals, device data, download logs, or usage records may be part of the response. Clear return policies, cancellation terms, trial disclosures, and checkout confirmations can matter when the customer says they were misled. A receipt alone may not answer every claim. The evidence has to address the specific reason the transaction was disputed. Dates are often the story. When did the customer buy, receive, complain, cancel, get refunded, or continue using the service? When the merchant challenges the chargeback, the response is often called representment. The merchant is essentially presenting the transaction back with evidence. The merchant's evidence usually goes to the acquiring side or processor, then back through the network path toward the issuer. The issuer reviews the response under the applicable rules. It may decide the merchant's evidence is enough or not enough. In some paths, the cardholder may be asked for more information or may continue to challenge the merchant's response. If the merchant wins, the disputed amount may be returned to the merchant side, although fees and operational costs may still remain. If the cardholder wins, the reversal stands. The merchant loses the sale amount and may also lose goods, time, and fees. Some disputes can go into additional rounds, depending on the network process, the reason code, and whether either side keeps challenging. At the far end, disputes can become more formal and more expensive. That is why many businesses try to resolve problems before they become chargebacks. One cost is the chargeback fee. The merchant may pay a fee for the dispute itself, separate from the transaction amount. Another cost is the product or service itself. If the item was already shipped or consumed, the merchant may not recover it. Even if a merchant wins or resolves the case, payment fees, processor fees, labor, support time, and shipping costs may not disappear. Processors and acquiring partners may monitor disputes because high dispute activity can create risk for the payment system. A business with too many chargebacks can face higher scrutiny, reserves, additional fees, stricter controls, or even trouble keeping card acceptance. That is why chargebacks are not just refunds with extra steps. They can affect the merchant's relationship with the payment system. One prevention tool is a clear billing descriptor. If customers cannot recognize the name on the statement, disputes become more likely. Receipts, order confirmations, renewal notices, delivery updates, and account emails help customers remember what they bought. For physical goods, tracking, delivery confirmation, pickup records, and address verification can reduce confusion and support a later response. Good customer support matters because many disputes start when a customer cannot get a clear answer, a cancellation, or a refund path. A fair, visible refund policy can be cheaper than forcing every unhappy customer to use the bank as the problem solver. Fraud screening, authentication, address checks, velocity limits, and suspicious order review can reduce some unauthorized transaction disputes. For subscriptions, reminders, easy cancellation, clear trial terms, and visible billing history can reduce disputes caused by surprise. The useful mental model is simple. A refund is merchant-led. A chargeback is bank-led and rule-driven. A refund is the cleaner path when the merchant and customer can resolve the problem directly. A chargeback is the formal path when the cardholder asks the issuer to challenge the transaction through the card system. That is the hidden business system behind a chargeback. A customer complaint becomes a structured payment dispute with money movement, evidence, deadlines, and rules. This is hidden business systems, simple explanations of the systems most people use every day but rarely see.